Right now, somewhere inside the bond market, a signal is quietly forming, one that has appeared before every major gold bottom in the last 50 years. 1971, 2008, 2018, 2023. Each time, it came just before the turn. And each time, almost nobody was watching for it. Not the headlines, not the analysts, not even most professional traders. But this week, that signal has started moving again. Interest rates are shifting in a way they haven't in months. And if history repeats, gold and silver may be closer to a major turning point than anyone realizes. The question is not whether the signal matters. The question is what happens to investors who ignore it. Because by the time this becomes obvious to everyone, the opportunity may already be gone. Stay with us, because what we're about to show you could change how you look at this entire market. Welcome to Currency Arc Insight, the channel dedicated to decoding the economic signals that shape markets before the world catches on. If this kind of strategic analysis matters to you, subscribe now so you never miss a warning like this one. And tell us in the comments, where are you watching from today? Most investors watch the price of gold and silver every single day. They check the charts, they read the headlines, and they react to whatever the market tells them in that moment. But the professionals who have studied precious metals for decades know something different. They know that the real story never begins with the price itself. It begins with a much quieter corner of the financial system that almost nobody outside of institutional trading desks pays attention to. That corner is the bond market, and specifically, the relationship between short-term and long-term interest rates. This relationship is called the yield curve, and right now it is sending one of the clearest signals it has sent in years. To understand why this matters, and it helps to strip away the complexity, the yield curve simply measures the difference between the interest rate on a 10-year government bond and the interest rate on a 2-year government bond. When that gap narrows, analysts call it flattening. When that gap widens, they call it steepening. For most of this year, that gap had been flattening, which is generally a sign of caution in the market and pressure on gold prices. But in recent weeks, something has changed. The gap has started to widen again, and it closed this week at its highest level in nearly 2 months. This shift may sound like a small technical detail, but for those who study gold closely, it is far from small. Years ago, a major research team at one of the world's largest bond investors studied what actually drives the price of gold over time. Their conclusion was that real interest rates, meaning interest rates after accounting for inflation, were historically the single biggest fundamental driver of gold prices. When real yields rise, gold tends to struggle. When real yields fall, gold tends to strengthen. That relationship held for decades. But in more recent market cycles, something interesting has emerged. The steepening of the yield curve has actually become an even stronger and more reliable signal for gold than real yields alone. In simple terms, gold does not just care whether interest rates are high or low. It cares about the relationship between short-term rates and long-term rates, and specifically, which one is moving faster. Here is why that distinction matters so much right now. Over the past several weeks, interest rates have been climbing on both ends of the curve. Short-term rates have gone up, and long-term rates have gone up as well. On the surface, that sounds like bad news for gold, since rising rates usually make non-yielding assets like gold and silver less attractive. But the details tell a very different story. Long-term rates have been rising faster than short-term rates, and when that specific pattern shows up, it has historically been a bullish, not bearish, development for precious metals. This does not mean gold and silver are guaranteed to move higher immediately. Markets rarely move in straight lines, and a temporary pullback or a false breakdown is still possible in the short term. What this pattern does tell serious investors is that the underlying fundamental backdrop for gold has shifted. It is no longer clearly negative. In fact, based on this specific signal, conditions may already be leaning positive, even if the price action on the surface has not caught up yet. This is the exact kind of disconnect that experienced investors watch for. Price and fundamentals do not always move together in real time. Sometimes the fundamentals shift first, quietly, in a part of the market that most people never check. Then, weeks or months later, the price eventually reflects that shift, often in a sudden and powerful way that catches latecomers off guard. For business-minded investors who understand the value of positioning ahead of the crowd, this is precisely the moment to pay attention. The yield curve does not make headlines the way a dramatic price swing does. It does not trend on social media. It does not generate exciting thumbnails. But it has quietly foreshadowed major turning points in gold before, and it appears to be doing so again. The next question, and the one that matters most, is what typically happens after this exact pattern shows up. History offers a surprisingly consistent answer, and it points to a very specific event still to come in the short-term interest rate market, one that is aligned with nearly every major gold bottom over the past 2 decades. That pattern is exactly what comes next. Every major turning point in the gold market has left behind a trail of evidence. That evidence does not sit in gold's own price chart. It sits somewhere most retail investors never think to look inside the short-term bond market, in a number known as the 2-year yield. The 2-year yield reflects what investors expect from the Federal Reserve over the near future. It rises when the market expects tighter policy and higher rates. It falls when the market expects the opposite. On its own, this number seems like a minor technical detail buried in financial data. But when analysts overlay the 2-year yield against the price of gold across multiple decades, a pattern emerges that is difficult to ignore. Time after time, when the 2-year yield reaches its peak and begins to roll over, gold finds a major bottom at almost the exact same moment. This is not a coincidence that happened once. It is repeated across several distinct market cycles. In the past, a peak in the 2-year yield lined up with a significant bottom in gold that kicked off a substantial multi-year rally. Years later, a similar peak in that same yield aligned with another major bottom, one that would eventually lead gold into one of its strongest bull runs in modern history. The pattern held again more recently, when a peak in short-term rates set the stage for gold to break out of a massive multi-year base and push toward new record highs. There was one notable exception worth understanding, because it shows why this signal must be read carefully rather than mechanically. During a period of major geopolitical shock, gold surged early due to a sudden safe haven rush. But once interest rate hikes actually began, gold peaked and pulled back, even though the broader yield pattern eventually still played out. This teaches a valuable lesson for serious investors. The 2-year yield signal is powerful, but it works best as part of a broader picture rather than a standalone trigger pulled in isolation. Right now, the 2-year yield has not yet peaked. It is still elevated, and short-term interest rate expectations remain a live and moving target. Many analysts believe the central bank is unlikely to raise rates again in the near term, though the exact timing of the next policy meeting remains a key variable to watch closely. Here is where the setup becomes genuinely interesting. History shows something specific happens when gold is declining into the start of a new rate hiking cycle. Instead of falling apart, gold has tended to bottom almost precisely when that hike is delivered. The moment of maximum fear in the short-term rate market has, time and again, coincided with the moment of maximum opportunity in gold. If that historical relationship holds again, then the setup unfolding right now deserves serious attention. A steepening yield curve combined with an approaching peak in short-term rates has, in the past, formed one of the most reliable combinations for identifying a major bottom in precious metals. Investors who understood this relationship in previous cycles were positioned well before the broader market caught on. Those who waited for the price action to confirm it on its own often found themselves buying much higher after the easiest gains had already been made. None of this guarantees an exact bottom on an exact date. Financial markets rarely offer that kind of certainty, and false signals do happen. Gold could still test lower levels before this pattern fully plays out, but the historical weight of evidence is difficult to dismiss. When the 2-year yield stops rising and begins to turn lower, it has consistently marked a moment of strategic importance for anyone holding or considering holding gold and silver. This is why serious investors do not wait for confirmation in the headlines. They track the mechanics underneath the price, the same mechanics that quietly foreshadowed every major bottom before this one. The pattern has repeated with remarkable consistency across very different economic environments, different decades, and different global events. That kind of consistency is rare in financial markets, and it is exactly why this particular signal deserves far more attention than it currently receives. But a repeating historical pattern raises an obvious question. Why would something this reliable be building right now at this exact point in the economic cycle? The answer lies in a much larger problem building beneath the surface of the bond market, one involving debt on a scale the modern financial system has never had to manage before. That problem is where the story goes next. Behind every yield curve movement, behind every rate decision, there sits a much bigger and far less discussed problem. It is not a problem that shows up in daily headlines, and it is rarely explained in simple terms, but it may be the single biggest force shaping what happens to interest rates, and therefore to gold and silver over the next several years. That problem is the sheer scale of government debt that now has to be refinanced. To understand why this matters, it helps to think of government debt the way a business owner thinks of a loan. When a loan comes due, it either gets paid off or it gets refinanced at whatever interest rate is available at that time. Governments work the same way, except at a scale that is difficult to fully grasp. Trillions of dollars in existing debt are set to mature and require refinancing this year alone. And every bit of that debt has to be refinanced at today's interest rates, not the lower rates that were available when it was originally issued. This creates a mathematical problem that becomes more serious the higher interest rates climb. Even a small increase in the average interest rate on that debt translates into a massive increase in interest payments. A rise of just 1 percentage point can add hundreds of billions of dollars in additional annual interest costs. When measured against total government revenue, That kind of increase represents a significant new burden, one that competes directly with every other government spending priority. This is not a distant theoretical risk. It is already visible in the data. Net interest payments on government debt have climbed to levels not seen since the aftermath of the Great Depression. That comparison alone should give any serious investor pause, because it signals a level of financial strain that historically has not resolved itself quietly. At the same time, long-term bond yields have been under clear upward pressure. 30-year yields have pushed to fresh highs, and 10-year yields are approaching levels that have not been tested in years. Rising long-term yields make new borrowing more expensive. They make existing debt more costly to refinance, and they place mounting pressure on a financial system that has grown increasingly dependent on low borrowing costs to function smoothly. Here is where history becomes a useful guide. There have been previous eras when long-term interest rates climbed persistently higher over an extended period. During one such era, in the late 1960s, rising long-term yields eventually became severe enough to end a multi-decade bull market in stocks and mark the beginning of a difficult, high-inflation economic period. What followed was a prolonged stretch in which hard assets, including gold and gold-related investments, significantly outperformed financial assets. The difference between that earlier period and today is scale. The amount of total debt across the economy, government, corporate, and household combined is far higher today than it was during that earlier era. That means the modern financial system is more sensitive to rising interest rates than it has ever been. A free, unmanaged bond market, one where interest rates are simply allowed to rise as high as economic forces dictate, becomes increasingly difficult to sustain when debt levels are this elevated. This is precisely why many analysts believe policymakers will eventually be forced to intervene directly in the bond market. Historically, when debt burdens become this large, central banks and treasury departments have stepped in to manage long-term interest rates, rather than allow market forces to set them freely. This kind of intervention has taken different forms in different eras, but the underlying goal is always the same: to keep borrowing costs manageable, even when natural market pressure is pushing them higher. For gold and silver investors, this dynamic carries an important implication. Direct intervention to cap or lower long-term interest rates, whatever form it eventually takes, has historically been extremely supportive for precious metals. When policymakers prioritize managing debt costs over maintaining a fully free bond market, it typically weakens confidence in the long-term value of currency itself. That loss of confidence tends to flow directly into demand for gold and silver as stores of value outside the traditional financial system. At that point, the precise level at which gold or silver bottomed becomes almost irrelevant to long-term investors. What matters far more is being positioned before that shift in policy becomes obvious to everyone. This debt dynamic does not exist in isolation either. It connects to a much larger, multi-decade pattern in how capital rotates between financial assets and hard assets, a pattern that has repeated with striking consistency across the last century. That rotation is where the story goes next. Every long-term investor eventually asks the same question. If a major shift in gold and silver is approaching, how does someone actually prepare for it before it becomes obvious to everyone else? The answer lies in a pattern that is quietly repeated across the last century, one that connects the stock market's biggest peaks to the beginning of major bull markets in hard assets. History shows a consistent relationship between secular peaks in stocks and secular bull markets in gold, silver, and mining shares. A secular peak is not an ordinary short-term high. It marks the end of a multi-decade uptrend in stocks, followed by a long stretch where financial assets struggle while hard assets thrive. This rotation has happened several times before, and in each case, the lag between the stock market peak and the resulting bull market in precious metals followed a strikingly similar timeline, typically unfolding somewhere between 8 and 11 years later. This detail matters enormously for anyone trying to judge where the current cycle stands. If the broader stock market has not yet reached its secular peak, then the resulting bull market in gold, silver, and related mining investments may still be in its early stages, regardless of how far prices have already climbed. Investors who assume a rally is finished simply because it has already produced strong gains often overlook how long these secular cycles have historically lasted, sometimes stretching across 15 or even 20 years from start to finish. Sentiment data adds further weight to this view. Capital allocated into gold mining investments relative to the broader stock market remains historically low, even after recent gains. This is a meaningful detail, because major bull markets rarely end while participation remains this thin. Surveys of professional fund managers have also shown a notably high number expressing the view that gold is undervalued, a reading not seen in several years. Historically, this kind of sentiment has appeared closer to the beginning of major moves than the end of them. None of this means gold and silver are guaranteed to move higher immediately, or that near-term weakness is impossible. Markets can still test lower levels, shake out weaker holders, and create additional volatility before any larger move takes hold. But for long-term investors focused on positioning rather than perfect timing, these short-term fluctuations matter far less than the broader structural setup underneath them. This is precisely where a disciplined, business-minded approach becomes essential. Rather than attempting to catch the exact bottom, experienced investors tend to focus on quality. That means identifying companies with strong underlying assets, reasonable valuations, and meaningful upside potential relative to current metals prices. It also means having the discipline to hold through short-term volatility once a position is established in a fundamentally sound investment, while trimming positions that become significantly overextended. This approach requires patience, something that is often in short supply during periods of market uncertainty. But patience, paired with a clear understanding of the underlying macro signals already discussed, has historically separated investors who captured the bulk of a major move from those who missed it entirely. The investors who positioned themselves ahead of previous gold bull markets were rarely the ones who waited for certainty. They were the ones who understood the underlying signals, accepted the uncertainty that comes with early positioning, and prepared accordingly. Taken together, the picture becomes clearer. A steepening yield curve, an approaching peak in short-term interest rates, an unprecedented debt burden pressuring long-term borrowing costs, and a stock market that has likely not yet reached its final secular peak. All of these forces point in the same direction. They do not promise an exact date or an exact price. What they offer instead is a framework, a way of understanding why this particular moment carries more significance than the average investor currently recognizes. For those paying close attention, the signals are not hidden. They are sitting in plain sight, inside bond yields, inside sentiment data, inside historical patterns that have played out again and again. The challenge has never been a lack of information. The challenge has always been recognizing the significance of that information before the broader market does. What remains is bringing these threads together into a single strategic conclusion, one that explains not just what these signals suggest, but what serious investors should actually do with that understanding right now. That conclusion is where this story ends.